Well, we saw North American markets rally at the start of the day with signals that the trade war with China won't last. But then some gains were erased this afternoon on some different news. Let's go to Jason Vicario. He's a portfolio manager at Hillside Wealth Management with IA Private Wealth. Thanks for joining us today.
Thank you.
We are seeing another up and down. I'm wondering if it's another wave of uncertainty that investors at this point need to just expect.
Yeah, I mean, it seems par for the course over the past few weeks and months here. If you're going to focus on trade, tariffs, what's going on south of the border, I think investors can expect a serious case of whiplash because it seems to be changing daily.
Okay, so let's talk about the characteristics of a business that can actually weather these storms we are going through. What do you see?
Sure. Well, I mean, at Hillside Wealth, we favor exclusively high quality businesses. And in short, the way we define high quality is businesses that can consistently and have shown a history of demonstrating strong returns on invested capital. They're ideally founder-run, founder-owned, so the people that are involved in the business have a meaningful stake, and therefore they're aligned with shareholders. And then, of course, from a granular perspective, we're looking for businesses that have high margins, low debt, especially those with low debt. They can really be on their front foot during periods of economic weakness or uncertainty and gain market share. So those are some of the things that we look at in the way that we define high-quality businesses.
Okay, so where geographically are you finding companies that meet those criteria for you?
Well, geographically, we're finding companies that meet the quality criteria really all over the planet. But it's not so much just for us that we find a high quality business, but it also has to be available at a price whereby the price represents a forward rate of return above our hurdle rate, so that when we put our capital or our clients' capital to work, we expect a rate of return that exceeds our hurdle rate. And lately, we've been finding opportunities, so high quality and reasonable valuations in geographies such as the UK, Hong Kong, and Japan.
Okay, has that changed over time, or are those new places that you're focusing on?
Yeah, that's a great question. I mean, it does change. UK kind of really came on our radar post the Brexit scenario, which was, from 2016. So that's been sort of 8 years now that area has been reasonably valued. Japan has been reasonably valued probably for around a decade or two, and Hong Kong more recently, just with the geopolitical risks, let's say call it between China and the US. So yes, it does change. If we saw a market, let's say in Sweden, drop all of a sudden by 50%, Sweden has a number of high quality businesses. So yes, it is dynamic and it does change.
Okay, any concerns when you factor in the tariff war? You refer to it just generally with Japan, but just with the countries that you are now looking to. The UK obviously doesn't have a lot of exposure, so I'm wondering if that has changed the way you're looking at some of these areas.
Right. So, I mean, as you and I just spoke about at the beginning of this segment, this seems to change all the time, and it is beyond our control. So we at Hillside prefer to focus on things that are within our control, which is really bottom-up investing, looking at businesses, analyzing those businesses, making a call on the quality of the business, the valuation, and then the conviction, how much we're willing, how much capital we're willing to deploy in that business. People who have money that they need less than 5 years should be primarily invested in things like GICs or term deposits. For longer-term investors, so people that need money beyond 5 years, they should be primarily invested in equities or stocks or owning little pieces of businesses. We think in terms of decades. So we're trying to really understand what a business might look like in 5 years, 10 years, 20 years down the road. And if you have that type of time frame, we just accept that we're going to have periods of low inflation, high inflation, low interest rates, high interest rates, spicy tariff or geopolitical situations, might we call it, or calm geopolitical situations and everything in between. So I think it's really important for investors to separate the activities and behavior that are within their control, namely analytical work and also sort of the psychology of investing, and then the areas that are beyond their control, as I just outlined, and to really differentiate between the two and focus on the areas that are within our control. And that's what we try and do.
I know that you have mentioned that resource exploration, extraction, that kind of thing is not a sector that you're interested in. Tell me why.
That's a great question. So As I mentioned, the way we define high quality businesses are primarily businesses that have been able to consistently generate strong returns on invested capital. If you pull up an oil or a gas or even a metals exploration and production company, you will see that their returns on capital sort of go up and down like a yo-yo. And that's really a function of the commodity price that they are then in turn taking to market. Similarly, to take oil out of the ground or to take metal out of the ground, that's very capital intensive. So I didn't mention this earlier, but one of the tenets that we look for are capital light businesses, meaning businesses that can maintain and grow their operations without requiring a lot of capital infusion. And resource companies typically don't meet those two criteria.
Yeah. I also want to get your take on the fact that because of the uncertainty now, and maybe it doesn't matter, as you mentioned, you look well down the road, that companies are either not providing guidance or providing scenario guidance, one or two scenarios that could be affected in the near term by the uncertainty in the trade war. What's your take on the way this is progressing?
I'm smiling because our preference at Hillside is that the companies that we are invested in or would like to invest in don't provide guidance at all. We feel that Wall Street, sort of a Wall Streetism of this guidance, this quarterly guidance or even annual guidance, really hamstrings management in terms of making investments and behaving for the long-term creation of shareholder wealth. So I can't really comment other than to say we would really prefer that companies don't provide any guidance at all.
Interesting. All right, Jason, I've got to leave the conversation there. Jason Vicario is a portfolio manager, Hillside Wealth Management with IA Private Wealth.